between 3:15 and 3:45, the last hour macro, it will run on liquidity that has not been engaged. Meaning, here's 3:15 New York local time, 3:45. That's your last hour trading the macro. The algorithm will do a spooling. Okay, spooling. Think of it I got questioned by a few folks about this. When I say spooling, imagine you're a fishing, um, you're holding a fishing pole, okay, and you cast the fishing rod out into the water. When the fishing line is leaving the spool, it's just like it's running, it's dragging out that line. That's what that's what it's going to do. It's going to run out the line like you're standing right here. You're going to cast the fishing pole, and the line keeps going out, and you're aiming forward to drop your lure into this area right above here, because right above here is what buy side liquidity. So you could be a buyer trading down here at some random level, a volume imbalance, order block, buying that at the 15 minute after 3 o'clock and expecting price to start delivering higher. And once it creates this scenario, you are entering into a buy program. A buy program is not a market maker buy model. Okay, I see a couple of students interchangeably using that. That's not what's going on. A buy program is when when the algorithm starts going into buy side delivery, meaning it's going to keep booking price higher and higher. It does not matter. Listen, folks, I don't care how long you've been trading, who you know, what firm you worked with, you used to make the markets at so and so's, crude oil option market. You're not a market maker, you're a dealer. When you look at the market from the perspective of the algorithm, is what we're seeing here, and I'm bringing it to you every day. When the market starts delivering price higher, it matters not how much buying pressure there is or how much selling pressure it is. It's going to go there regardless of whether you want it to or not. You could be bearish all you want. Everybody could be screaming about it on the marketplace, sentiment message boards, forums, Reddit, everybody. It won't matter, because if the market's going to go there, it's going there. And it can do so with low volume, which blows out the whole argument about buying and selling pressure. The market rallies from here and enters a buy program. Buy program is when the market just starts booking higher prices until we get to a pool of liquidity. In this case, it would be buy side here, or a premium inefficiency, which would be an example like this right here, this small little fair value gap. So the difference between this candle's low and this candle's high is a SIBI, sell-side imbalance, buy-side inefficiency. That's the classification of this particular fair value gap, meaning it only offered sell-side. So to be repriced correctly and have an efficient fair value offered to the marketplace between this candle's low and this candle's high, it will want to reprice up to it here like it does with up close candles. The market will deliver it on up basis. So it's now offered efficiently through the scope of fair value. It is not rebalanced because it did that. That's not rebalancing, it's repricing. When it leaves this range, then it is balanced. Then it's likely to support price where it doesn't need to go back down there. So that's the only distinction I'm going to make here. Now go back to that low. Once it enters the buy program, you know that it's likely to trade up into here. Why? Because I already explained it this morning. We've already worked lower. I showed you where the smart money shift to bullish, why they're going to be reaching for all this buy side. Everything was explained in that live stream. Go back and listen to it. It would be wasteful for me to do it all again here. Once it starts rallying, every down close candle or series of down close candles, if there's ever a series of down close candles, you use that entire block of down close candles as one, because it's delivery that you're looking at, not just simply one candle. One candle does not make a narrative. One candle doesn't make a order block. It's this change in the state of delivery that is the order block. What do I mean by that? Let's dig into this. Three down closed candles. That opening price right there, that candle's opening price, you're going to look at this value right here, okay? Look up here in the upper left-hand corner where I'm pointing. That's the open. That price is 4145.75. As soon as soon as that price is traded to and one tick above it, that becomes an order block. So young men and young women, please stop making videos pretending you're teaching order blocks because you have no idea what the hell you're talking about. This change in the state of delivery right there, once this occurs on that candle, this opening price becomes fair value. That means that the market, when it trades through it here, it's going to want to do what? Offer smart money, the traders that some of you don't believe exist. And when it comes back down and touches that, they're buying it. When it trades on this candle here and trades and goes down to it again, they're buying it. Their algorithm, which is high frequency, and it's hammering, constantly hammering the market at these price points. They're buying it here, they're buying it here, they're buying it here, and they're buying it here. Every single time we leave a down close candle, they're watching their positions move into profit. Every time that we see a new change in the state of delivery, it's offering them another opportunity to build their position and build it larger. Remember, the focus is over here. This is the draw on liquidity where the market's going to be pulled to. Why? Why should it go up there? Because there's buy side up there. Buy stops. Willing buyers to buy at a higher price when it's down here. Think about that. You're not taught to think like that in these books. Everybody writes these books talking about that's resistance. No, that's victims. That's new meat. That's flesh to be devoured. The market is the beast. It will consume the flesh that is dangling off the carcass right above these highs. That's the life essence of these markets. It's going to where the orders are. It has no respect of your pattern. It has no respect of a down closed candle that you're foolishly calling an order block when you don't know what you're talking about. It's going to where the actual orders are and inefficiencies. So the market's going to seek liquidity and fair value constantly. It's always this ebb and flow between the two. It's constantly trying to facilitate the most efficient model of delivery for price. That's the function of these price engines. It's doing that. It has no awareness how many contracts are being bought or sold. It has absolutely none. It doesn't even know how many contracts are resting above that. It just knows that once it does this and it stops here and pulls away, every trader is going to do the same thing. It's called priming. Priming is doing something with the expectation that the audience, viewer, or participant will begin to expect a specific outcome. Once that's done, once that hook is sunk in, it's over. The market goes down. When this pass here occurs, traders are going to look at that and say, oh, it's going to take out that low. They want to be short. Selling, selling, selling. Smart money's buying, buying, buying. Changing the state of delivery. Buy, 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 buy. Boom. Displacement. We're taking out a short-term high right here. Now, think, I just walked you through as close as I freaking can without getting in my own personal trouble here. This becomes the 2022 model. Think. Low, lower low. Sell side's taken. We're inside that time window between 15 minutes after 3 to 45 minutes after 3. So that closing hour, final hour of trading, you're going to see a macro run to the liquidity that has not been engaged. That's this over here within the context of a bullish market, which I gave you this morning. Changing the state of delivery, buy, 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 buy. Displacement, shift in market structure bullish. This is where I've been telling you to buy. This is where I buy. This is where I buy. That's where smart money engages. They're in early. How do you know to get in early? Because I know. I'm teaching you how to get in where it's obvious to see it. Isn't that obvious now? That's exactly what I taught you in the 2022 model. Shift in market structure. After liquidity is taken, bias is bullish. We have liquidity. Aim for it. Buy in this fair value gap. Okay. Don't trail the stop loss up real tight. I teach you that in the model. You got to get first profit before you ever roll your stop to anything considered break even or close to that. So are you stopped out here? No. You might be a little unsettled because you're new. That's normal. Market rallies, comes back into another fair value gap here, trades into it, rallies. Two down closed candles. We trade through it here. That becomes an order block. It's a change in the state of delivery. It's delivering now, buy side. The next candle opens here. What is that? It's a volume imbalance. It opens here, expected to trade back down. Just to close that gap to that opening price? No. Trade into this candle, that opening price. Trades into it, smart money will buy there. What happens after that? Rallies. It does not rally because smart money bought. It does not rally because smart money has more buying pressure. It rallies because it's rallying. It's designed and it's coded to do so. I don't give a shit who believes me. Rallies up, and we've priced rather handsomely above the relative equal highs here. Okay, so we see again another final trading day, final hour trading macro between 315 and 345. What's actually occurring there? I know some of you are asking, like, what makes that macro? What's the deal with that? It's a function that will make the most sense for some of you when you think that the market's bullish and we had a big bull day and it runs up, makes a high of the day, and then usually this time of day the market will pull off the highs and close near the high but not at the high. But if you're in a time when the market's trying to press out of a consolidation, which is what I outlined this morning on the daily chart, we're in this range bound consolidation. So the market's going to start probing outside those boundaries. I tipped you off on the side it's going to reach for this morning because it had already tried multiple times to go lower, and it's caught traders doing what? Selling short. Watch the live stream. It's all in my dialogue. Your focus was to look up all day, especially in the last part of the day. So here we are, we're up here, and by knowing what you're trading in terms of direction, and then you focus on specific times of the day where I'm teaching these macros exist, the 15-minute mark to 45 minutes after 3 o'clock New York local time, that macro is market on close. It means it's going to cause a price run as we get in towards the end of the day. If you do not have a clear setup and it's not obvious, you do nothing. You don't do anything. And you just wait for 20 minutes to 15 minutes before 4 o'clock. And then you'll get some kind of a 5 to 8, maybe sometimes 10 handle run. That's how I trade the last final hour trading. It's so systematic, it's so generic, it's so boring. But for a trader that's looking for continuity, something that repeats over and over and over again, it's hard to beat it. Like, it's really difficult to find something that would be easier. Even though it sounds too scientific, it sounds like there's a whole lot of conjecture here. If you've been with me for a number of months, you hear me saying the same things. And you see your chart printing exactly what I taught you it's going to do. Because it's coded to do that. You're not going to convince anyone in this group that this isn't algorithmic, that it's absolutely controlled, because they've been witnessing, they've handled it, they've seen it. And I know it's jarring to some people that maybe work in the financial realm here in trading, and maybe you're at a brokerage firm, maybe you're at a quote unquote bank, maybe you're at a trading institution, okay, something to that effect. And you only know what they trained you to perceive price as. So you're indoctrinated. I'm on the other side. I've been where you're at. I'm on the other side. I'm telling you how these markets are booking, and I'm proving it daily with every single 1 minute candle. If it wasn't algorithmic and I didn't know what the hell I was talking about, it wouldn't work, would it? then I if it ain't that, then I figured out the code of buying and selling pressure, right? It's ridiculous. It's not that. It's not that at all. And when people just simply relax and disarm themselves and just warm up to the idea that this is a benefit. If the market is rigged, which it is, there's no reason to fear that. But you should fear over trading, over leveraging, pushing a mythical edge that you think exists with retail stuff. Because when you make money, it has nothing to do with you doing something right with a pattern. You just happen to be on side at that time and use proper money management. The money management is what made most people profitable, not the actual trading. Because if you sit down with most retail traders, even the ones that do really well, and well means they make a lot of money, not just making their ends meet. They make a lot of money. If they're honest, they'll tell you that their strike rate's really low, and it sounds shocking to the average person, to a lay audience member. They're like, "There's no way you're making all that money and your strike rate is that low. Surely your strike rate has to be extremely high." No, the money management does all the heavy lifting. They know how to cut losers. They know how to lose. They know how to take the losses and not go nuts about it, and they let their runs run, so they can afford to trade with a low strike rate. I'm not happy with a low strike rate. And I don't want my students to satisfy themselves with a low strike rate. I want you to know when to do certain things, when to avoid trading, when to anticipate when it's going to be hard. Because if you know when it's going to be hard, you won't be inclined to do what? Over trade, over leverage, push it when you take a loss, try to get it back real quick. You wait. And it gives you peace of mind. It gives you absolute control over the trader, where most of you don't have that. You're reckless. I was reckless as a 20-year-old. I did all these things foolishly too. But once you know what it is you're looking for, how you're going to engage it, what procedures and processes do you go through while doing it, and also knowing when to pull the plug. When do you turn the charts off and walk away? That's what this mentorship is. It's not buy here, sell here, stop here, target here, partial here. No, 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 no. I've already taught that. That's already on my YouTube channel. This is the part that none of you want to go through, but this is the part that's required for you to do it well. You can get lucky doing my stuff. You happen to be on side at that moment, but not understanding why you're on side. On side meaning that you're on the right direction in the marketplace. And if you look for certain things that I teach, invariably you might get lucky once in a while. But you want to know that you know that you know. And that's what I'm trying to teach you. I'm teaching you how to perceive price in its most opportune time and avoiding it when it's not in those conditions. You can study it, but don't touch it. It's going to hurt you. It's like that hot pan. You walked in the kitchen, you don't know how long that hot pan's been sitting there. Has it been cooled off for a long time? You don't know. So what do? You walk over and you get your hand real close to it because you're an adult. You don't want to get burned. You're going to feel, is there any weight or heat waves coming off of that? Because you don't want to touch and get burned. But as a child, what did you do when you came in there? Oh, look at this. Grab, burnt. And that's what all of you are doing when you're rushing to get these funded accounts, when you're rushing to trade with live accounts, when you're even rushing into a demo. And you're fortifying toxic thinking and fear when you don't need to be fearful of trading. You don't need to be fearful of it. You need to respect the risks, but don't be fearful of being wrong. Those instances where you're wrong, that's where you're going to learn the most. But you're trying to avoid those instances, which is doing what? Deferring any real learning. Wow. Didn't think about it like that, did you? You have to grow through some adversity, some pain. And that uncertainty that you're trying to avoid, you got to press into that. It's fun. Once you learn, you're like, wow, I'm not afraid of that anymore. I know what I'm looking for. If it doesn't work here, it's okay. I know it's going to repeat in the future multiple times, more times than I've done it wrong here. That's the proper mindset. But it's hard to fortify that mindset in the beginning when you don't know what the hell you're doing, what you're looking for, why you're doing it. You're just trying to copy something you thought you saw somebody like myself or someone else on social media. This is what we do here. We're trading on fair value gaps. This is what we do here. We trade on order blocks. And you don't really understand what you're doing. So hopefully you will all take advantage of me spending time with you this year and learning how to do this properly. So that way, when we go into 2024, you will be an independently minded trader. You'll know exactly what your model is. You won't be swayed by social media influencers, me included. You won't feel the necessity to come back to my channel. You won't have to support me with ad revenue. You won't have to come back here and ask me any questions because you'll know what it is you're doing. And that's exactly my goal for all of you. So hopefully you learned something from this one. I will be back with you all again tomorrow at the morning session. I'll be live streaming again. And so I'll talk to you then. Be safe. All right, so we're going to show you something here. This is when you are anticipating a run above a high and you're late to the party. See this wick right here? About halfway is right there. About right there. Eyeballing it. So if it trades down to that point, just a little bit more. Just a little bit more. This is a high frequency trading algorithm macro. Yeah, I missed it. I'll take that wick right there. Stop will go below the consequent encouragement of this wick right here. And this is going to accelerate pretty hard going into the close. So the stop is below consequent encouragement of that wick. And I like that. I'll add 10 more there. And we're going to rip through this high and keep going into the last 10 to 3 minutes of trading. And that is seen like this. Now, obviously, at 4 o'clock, it doesn't stop trading. But anywhere between here and there's 350 and 357, right there. Okay, between these two lines right here, that's when it'll stop spooling. These other couple minutes, they are going to be retracement and moving down away from the run that's creating, going into this area here. So in short, straightforward terms, this is going to go higher. I'm positioned. I wasn't able to get long on any of this in here, despite looking at this as a draw. I had limit orders in here to get this fair value gap. It didn't offer it. I had a limit order inside of here. It didn't offer it. And I had a limit order here and didn't offer it. So I just kept pushing. So I'm positioned on now using a high frequency trading algorithmic entry. We're going to go through this and rip and keep running through. We're not going to go up and reverse. We're going to go up and keep expanding in. The hot time where it will start to increase and rally up will be from where it is now to that. Okay. And in this shaded area is just the element of time. The time at which the algorithm will start spooling price. Okay, so study it with that in mind. And this is the close, so I'll just make that, I'll black that out. So that's the close. So now watch how it behaves. I can take this off there because you've seen where the stop is and why. and I'll buy that because we're digging into this wick here. It's a swing low, so we're digging into that consequent encroachment of that. That's what I was aiming for as an entry. And now we'll see this completely rip and go higher. The PM sessions, as of late, and this is kind of like characteristic of the new year. One of the reasons why I like to ease into a new year and wait till like the second week of February is I want the new year uncertainties, the building of sentiment, the running against the end of year and previous year's sentiment. I want all those things usually worked out. And because traditionally, people are really good starters as a trader, they're in a hurry to get out there and do something after being on their side, on their hands on the sidelines over the weekend and over the holidays. When the market starts trading again from the previous session or after the holiday break, there's a lot of anxiety, impatience. They want to get out there and get into something, and because of that, there's usually there is a great deal of volatility, and the purest price runs are going to be in the morning session. Because traditionally, people are good starters when they're traders. They want to jump out there, plow into it, not really respect the risk. They just want to get out there and just do something. Most of it's like lottery trading, where they just put a position on a big trade and hope it pans out, or hope and prayer model, where you don't even know what you're doing. It's been going up, so let me buy it, or if it's been going down, let me sell it, and then hope it pans out for you. That generally doesn't work all that great, and you probably can hear my puppy snoring. That's Piper. Bailey, not Bailey. Scout has her paw across her throat. She's not hurting her, but it's just they're snuggling up together. But my point in saying all that was that the PM session tends to be a little bit more lethargic, and usually it can be a lot more eventful once we get a little deeper into the year. Barring the summer months, the doldrums of summer, they tend to be a little bit more subdued in the PM session. Now, obviously, when I say things like that, people that are highly critical and just want to look for something to cry foul about, they'll find one day out of months and say, well, look at this. This day here did that. Well, of course, some days it rains. And it's usually the day you don't bring your umbrella. So you're going to make a big deal about it. Don't be Karen. So we have a fair value gap we're inside of right here. You see that? So we are looking at how price should expand higher. And we'll sit back here and watch it happen. We're entering that sweet spot where the market on close orders will start spooling price higher. No need for it to drop down because the sentiment has been today, going into the day. They sold it off pre-market, and then the rest of the day, they just kept digging it in, moving it higher, higher, higher. So there's going to be a run up into it for those people that have been trying to short it all day. They're going to ram it up them here going into the last few minutes.
I want to see if we can get to 860. 860, I'm content. I'll remove the risk now because we're in the last few minutes of trading. And that would cover commissions and no loss would be incurred. If we get above 52, I'll take off 10. $7 are there. Take this shaded area over here. So focus on what it does right here inside that shaded area. That's the element of time. Trade down into an order block here. And retail sees this as, oh, it's topping. And go short. Let's see, what do I want to do here? The little line thing's what I want, sorry. Right there. That's the order block. And there we go. Just like that. Just like that, my friends. It's almost like I wrote it. There you go. So, hope you found that one insightful. Until I talk to you next time. Be safe. So what I've done is I've measured the range from the high to the low of that 15-minute fair value gap. You're familiar with the low and the high, and in the middle is consequent encroachment, because any gap or inefficiency, that midpoint is going to be highly sensitive. But if you're bullish, you want to see it not return back to, okay, and this is for your notes, just like when you see me talk about how I want to see the fair value gap not filled in, I want to see it remain open. Preferably if the market can trade back down into the upper portion of that fair value gap when you're bullish. How far, but not touch the consequent encroachment, the upper quadrant. You can see it hits it here, and then rallies through. So I want to take you into the last hour of trading and revisit that final hour macro. And a macro is a short little list of instructions or directives for an algorithm to run, and they tend to repeat. The only time that you're going to see them not work is when we have already moved a lot in either the middle part of the day or right after lunch. It does whatever it was supposed to do in terms of running for liquidity. And then the last hour can be just listless, choppy, not really doing too much at all. But I want to show you how the algorithm uses certain elements of price action and trigger points for how to determine standard deviations within a small micro market structure. And I know that's a whole lot, okay, but I promise it's a lot easier when you see it discussed. Here is that upper quadrant level of that 15-minute fair value gap. Okay, remember, here's that 15-minute fair value gap from the 9th of February. This is the midpoint of that. This is the lower quarter of it. This is the low. This is the high. And this is the upper 25% of that range. So if you would take a fair value gap and split it into 4 pieces equally, if you're bullish, you really don't want to see it trade down the consequent encroachment, but you're allowing that to happen. That your analysis allows for that. If it's really bullish and it comes down and touches this level here, you want to see that then support price. Do we see that here? And it rallies away? Yes, we do. What is this short-term high right here? If I move this out of the way, this short-term high, when price runs through it, right there, that candle's high comes in at 41.37.5. This high here comes in at 41.37.5. That candle, when it touches it just like that, you're watching to see is the next time it trades one tick right above that price, you now have a bullish market structure shift for the last final hour of trading. We get that right there. Notice the candle didn't close there. It went above it and came down here. Look back from that candle's high all the way to the low. What do you see between this high and this high here and that low? Well, you have to refer the 2 down closed candles here. That's a bullish order block. It's 1 block of price action. Half of that is essentially about right in here. When this candle pierced this high here, looking back, we have this, which is what? Volume imbalance. Then we have fair value gap right there. Do we want to see it trade back down inside this fair value gap once it's left it? Because we hit this one here. Why would we want to see it come back down and touch it? Because it's already done so here. Would it indicate that it's extremely bullish if it went back down there again? No. So we want to use a array, a specific element in price action that we would be more sensitive to see buying occur. Not that the buying is occurring here to send it higher. It's just that it's repricing back down to this candle's close that comes in at 41.35 even. And the difference between that and the candle's opening next is 41.35 and a quarter. So we're only talking about 1/4, one tick in difference in terms of price. So we have this volume imbalance. This would be your macro. What time is this candle touching the volume imbalance? 3:18. And this one before is 3:17. So what time is that? Between 3:15 and 3:45, that's your final hour macro. And you're expecting what price to run to what? Buy side. We're bullish. So what's above here? Buy side. So buy side's resting there. So this run from this high down, remember I was teaching with market structure, institutional market structure, and using it and coupling it with what? Liquidity pools. If we use this drop down, this is a trigger point for running standard deviation, meaning your fib, you anchor to the low up to this short-term high. Why that one? What's this the high prior to the retracement back down to an area where we would expect price to rally? Your standard deviations are noted here. There's your buy side. So which one are you looking for? It has to go above it. So which one are you looking for? 41.50 and even. So 41.50 even. And the final candle here at 1600, which is 4 o'clock, you want to have your position squared by then. What's the high of that candle? 4150.25. That's one tick. I taught you over the weekend that the market likes to remove mohawks. It wants to have a seamless delivery. It will not always stop right at the tick. Why? Well, you have the bid and the ask you have to worry about. This run from here to here, okay, you have to couple that with narrative and you have to couple it with liquidity. For instance, like what's over here? You have an old low, and if it's up here taking buy side with this run and it's dropping down, remember that 15-minute fair value gap? We took out what here? A short-term low, meaning what? We have a shift in market structure that's bearish, counter trend. So this is what I mean by traders that use my information. You can be buying and selling in the same day where one trader may be doing primarily one direction within a daily bias, but you can trade without a bias if you understand what liquidity is likely to provide in terms of the next draw. Small little fair value gap, it trades up into that, delivers below that short-term low. Now this may be a shift in market structure for some of you, and this one may not be because you're trading intraday volatility. The market returns back up into what? Consequent encroachment of that 15-minute fair value gap, which is that shaded area here. Remember, I've changed the color. Then it rolls down and attacks the sell side here. Using the same premise here, this is a trigger to start running your standard deviations from the high to that low. Here's your liquidity, or sell side liquidity. If you want to aim for something below that, what's below it? We have the old fair value gap down here. Standard deviation from high to low here. Below that low, we have this one. It hits it wonderfully. This one here is inside of the high end of the fair value gap that's shaded at 15-minute time frame. And then here is consequent encroachment. I'm sorry, the upper quarter, and this is consequent encroachment. You don't want to see, if you're bullish, you don't want to see that level hit. You want to see it respected in the upper portion of it because it'll act like what? An institutional order flow entry drill, where it just goes into an imbalance or a fair value gap and then runs higher. Well, you have a short-term low here. It stops right at that quarter point, the upper quarter of the fair value gap that's shaded in gray here. Remember, there's 4 levels to it. The low, first quarter, midpoint, which is consequent encroachment, 75% of the range, and then the high. So if it's going to go down to that quadrant here, which it does here, how far can it go? Using that reference point here, which is a trigger for standard deviations, the algorithm can reach as far as 41.30 and a half. That would be what? Allowing for this level to be hit, but also for anybody that knows the information I'm sharing with you, their orders will fill because of the difference between the bid and the ask. So 41.30 and a half, that could be a target where it reaches for. What's the low over here? 41.30 and a half. And then you get the run here. The shift in market structure on that candle, volume imbalance to the tick, runs it up to the fair value gap I mentioned. That would be the afternoon hourly, last hour trading's objective. Buy side's resting above that, and then it runs right into it there. The last minute of the last hour of trading right there hammers it. Look at the time I'm highlighting here. Okay, when you look at charts, here's the actual close of the session. Okay. But I like to see things go to the 4 o'clock hour. But there's always a little bleed over because at 4:15, that's when the closing bell occurs. And I don't have it on the right candle. I apologize. There it is. Okay. So there is the last hour and 15 minutes of trading. Your setup is going to form in the last hour between 3 o'clock and 4 o'clock. If you don't have a setup, okay, if you don't have a setup by 10 minutes to 4, don't do anything. Don't do anything. Just observe it. But generally, you're going to find between 3:15 and 3:45, which would be in New York time on TradingView, which would be 15:15. That is like a little tiny small sweet spot where if I know where I'm looking for liquidity above the marketplace if I'm bullish, below the marketplace if I'm bearish, or if there's an imbalance. What is an imbalance? Something like this. Okay, this is an imbalance, that's an imbalance. What kind of imbalance? Buy side imbalance, sell side inefficiency. Buy side imbalance, sell side inefficiency. Okay, I'm looking for that as a draw on price. It's going to pull it up to get back into one of these areas like it did here, or it's going to go up above an old high. So it's going to go to pools of liquidity above an old high or relative equal highs, or below an old low or relative equal lows, or it's going to go back to an area where it needs to revisit in a sense of repricing for the purpose of rebalancing. And simply because it goes back down in here, that's not rebalanced. It's balancing, but it's rebalanced once you leave it because it then becomes a balanced price range.